Amazon just axed 14,000 UK jobs in a single week. 14,000. Let that number sink in. Their Shoreditch headquarters, once employing more than 3,500 people, now has barely 800 left. Manchester operations are running on skeleton crews. Their Edinburgh tech hub has been shut down entirely. And Amazon wasn't alone. Meta followed with 8,000 UK layoffs. Google cut 6,000. Microsoft another 4,500. In just 6 months, 42,000 high-paid tech jobs vanished from the UK. Here's the number that should terrify every homeowner, landlord and property investor. On average, every lost tech job destroys around £12,000 in surrounding property value. Do the maths. That's over £500 million wiped directly from UK property prices just from layoffs. That doesn't include forced sales, collapsing rents, or the commercial property implosion that follows. Before we go further, if you want to understand where UK house prices are really heading, not the headlines but the data underneath, like this video and subscribe to UK Property Report. This channel tracks what's actually happening in the UK property market, not what politicians want you to believe, and it could save you from making a very expensive mistake. While this was unfolding, the Mayor of London stood at City Hall claiming London remains Europe's undisputed tech capital. While he was speaking, 3 more tech companies quietly announced UK office closures. The gap between what's being said publicly and what's happening on the ground has never been wider. Over the past year, I've tracked every major tech layoff, lease break and office closure across the UK. Not the polished press releases, the real numbers buried in filings and internal data. The picture is far worse than most people realise. Amazon's UK workforce is down nearly 70% from peak. Meta's London headcount has collapsed from around 4,000 to just over 1,200. TikTok recently paid £40 million simply to escape its Farringdon lease early. Companies don't do that unless they know demand isn't coming back. The property market in tech-dependent areas isn't cooling, it isn't correcting, it's imploding. Shoreditch prices are down around 34% from peak. King's Cross is down close to 30%. Canary Wharf tech-heavy towers are down as much as 40% on forced valuations, and this is still early. Amazon is the clearest case study. At peak, it employed around 35,000 people in the UK. Today, that number is closer to 11,000. That's 24,000 high-income jobs erased. The average Amazon tech salary was roughly £85,000 to £90,000. That means more than £2 billion a year in household income has vanished from the UK economy. But the real damage isn't just job losses. Amazon abandoned physical space. Their Shoreditch headquarters, over 1 million square feet, is now more than 70% empty. Principal Place, once a symbol of London's tech future, has entire dark floors. In Manchester, a hub marketed for 5,000 workers never exceeded 1,200 and now sits closer to 300. Edinburgh was even worse. Amazon promised 10,000 jobs by 2025. They delivered around 2,000 by 2023, then shut the entire operation. 2,000 households in a city with limited alternative tech employment suddenly lost income, and when income disappears, properties get sold. Apartments bought at peak valuations, buy-to-lets bought on thin yields, family homes bought assuming dual 6-figure incomes, they all hit the market at once. This is how housing crashes actually start. And Amazon's impact doesn't stop with its own staff. Every tech job supports 3 to 4 other jobs: cafes, gyms, childcare, cleaners, local retail. So 24,000 Amazon jobs lost means close to 100,000 total jobs affected. That's the purchasing power of a city the size of Cambridge disappearing almost overnight. Amazon isn't unique. Meta's King's Cross campus was designed for 6,000 workers. Today, entire wings are sealed off, cafeterias closed, lights controlled by motion sensors because there's no one there. Google bought its £1 billion King's Cross building in 2021 and is now trying to sublease up to 60% of it at almost any price. There are no takers because everyone knows UK tech demand has collapsed.
Microsoft shut its Reading campus entirely. Oracle moved its European headquarters to Dublin. Salesforce cut UK headcount by more than 70%. Startups are worse. In 2022, London had around 3,200 fintech companies. Today, fewer than 800 are meaningfully operating. The rest are zombies, technically alive but with no funding and no future. Venture capital tells the real story. UK tech funding peaked around £29 billion in 2021. This year, it's closer to £6 billion. That's not a slowdown, it's an 80% collapse. Investors didn't just become cautious, they left. Residential data from tech areas now looks like an emerging market collapse. Shoreditch average prices are down around 34%, but averages hide reality. New builds are down 45 to 50%, converted warehouses down over 55%. Some individual properties are down 60 to 70%. A penthouse that sold for £2.4 million in 2021 recently resold for £900,000. The owner lost £1.5 million in 3 years and still considered himself lucky to find a buyer. Transaction volumes have collapsed. In Hackney, sales are down more than 65%. Average time on market has jumped from under 30 days in 2021 to well over 140 days. Estate agents report entire weeks without a single viewing. The rental market is breaking too. Flats that once rented for £4,000 a month can't attract tenants at £2,000. Landlords are offering months of free rent and still can't fill units. Build-to-rent developments are in serious trouble. Major schemes in Tech City and Old Street are more than half empty despite heavy rent cuts. ONS data shows London lost more than 110,000 international workers in a single year. Not tourists or students, workers with jobs and mortgages. Tens of thousands from the EU, the US, Asia and elsewhere left. British tech workers are leaving too. LinkedIn data shows large migrations to Dubai, Singapore, Austin and Berlin.
At the same time, UK tech job postings are down over 70%. Salaries are down 20 to 25%. Senior developers who earned £180,000 in 2022 are now accepting £120,000 or less. The demographic shift is brutal. Shoreditch lost over 30% of its population, King's Cross nearly a quarter, Canary Wharf close to 20%. This isn't mild decline, it's evacuation. While this unfolds, City Hall hosts glossy tech events nobody attends. London Tech Week saw empty halls and withdrawn sponsors. The response is more marketing and promises about AI. But AI companies employ fewer people, not more. OpenAI's UK office employs fewer than 20 people, Anthropic even fewer. AI removes jobs. It doesn't replace tens of thousands of mid-career earners. Behind closed doors, the tone is different. Transport data shows tube usage in tech corridors down more than 40%. Revenue projections are collapsing. Internal modelling suggests London could lose hundreds of thousands of jobs by 2026, with property values down 30 to 40%. This is where pensions and banks come in. UK pension funds piled into London commercial property, especially tech offices, treating them as safe income assets. They weren't. Legal & General's property fund is down more than 40%, Aviva down close to 38%, Standard Life down nearly 50% on internal marks. These losses are hidden because assets haven't been marked to market. Forced sales are exposing reality. One Canadaga Square sold for £1.2 billion in 2019 and is now valued closer to £400 million. Amazon's principal place would likely fetch less than half its 2021 value. Meta's properties are effectively unsellable without fire sale pricing. If your pension is exposed to UK commercial property, you've already lost 30 to 50% of that allocation. You just haven't been told yet.
UK banks lent more than £200 billion linked to tech jobs and tech property. Barclays has around £11 billion in exposure, with a large share already distressed. Lloyds and NatWest face similar issues. Personal lending is worse. Tech workers borrowed 6 to 8 times salary assuming permanent employment. Now many are unemployed or earning far less. Defaults don't happen instantly. Savings run out, redundancy pay ends, mortgage resets hit. The Bank of England assumes unemployment peaks at 8%. In tech hubs, it's already above 20%. The models are fantasy. By early 2025, defaults are expected to surge, but there's no money for bailouts. National debt is near 100% of GDP. This isn't 2008. Assets fall instead of being rescued. Local economies are unraveling. Restaurants close weekly. Gyms sit empty. Private schools can't fill classes. Even crime is falling because the money is gone. Construction is next. Office to residential conversions no longer work. Luxury refurbishments are paused. New builds are abandoned. Tens of thousands of construction jobs are already gone. The timeline is clear. Late 2024 brings more layoffs. Early 2025 brings earnings-driven cuts. Commercial property funds freeze. Developers fail. By mid-2025, London property in tech areas is down 40% or more. Negative equity spreads. Transactions freeze. By late 2025, prices stabilize at much lower levels. Every collapse has winners. Sovereign wealth funds are raising huge war chests, waiting for 50 to 60% discounts. American private equity is preparing to turn owner-occupied homes into permanent rentals. Ultra-wealthy individuals who sold early will buy back assets at pennies on the pound.
This isn't cyclical. London's tech ecosystem took 20 years to build and was destroyed in 2. The talent is gone, the capital is gone, the confidence is gone. Finance is automating, law is shrinking, consulting is offshoring. The high-wage jobs that justified million-pound homes don't exist at scale anymore. London is becoming a city of tourism, administration, and legacy finance. That's not enough to support 8 million people at current costs. Young talent knows it. They're leaving. Behind the scenes, City Hall is panicking. Business rates from empty offices are gone. Council tax from fleeing residents is gone. Transport revenue is collapsing. They're modelling government bailouts, but the government is broke too. The austerity coming will make the 2010s look mild. Let's be clear, this isn't speculation, it's arithmetic. 42,000 tech jobs lost equals roughly £500 million in direct residential value destruction. Add multiplier effects, billions more. Add commercial property, tens of billions gone. London property must reprice to employment reality. That means 40 to 50% drops in tech areas and 20 to 30% elsewhere. Amazon didn't cause this, it triggered it. Overvaluation, leverage, and unrealistic assumptions made it inevitable. Amazon just pulled the pin. For homeowners in tech areas, the message is brutal. Sell early or accept the losses. For buyers, patience will be rewarded. This has further to fall. For London, the dream is over. The tech capital of Europe is now a warning of what happens when cities bet everything on one industry. The collapse isn't coming, it's already here, and Amazon's 14,000 layoffs were just the beginning.